3 days ago, something unprecedented happened. The Department of Justice served the Federal Reserve with grand jury subpoenas, threatening criminal charges tied to the Fed Chair Jerome Powell given his testimony last June. Powell is saying this isn't about remodeling buildings, but it's actually about interest rates. If he's right, this isn't just about political drama. It's a sign something structural is actually breaking. Officially, the investigation centers on the remodeling of historic Fed buildings in Washington. The costs were originally estimated to be around $2.5 billion, but it was later revised close to $3.1 billion. Prosecutors are examining whether Powell misled Congress during his June testimony about the scope and the cost of this project. That's the stated justification. But here's the problem. However, if this really were about renovation overruns, it would be a civil dispute, an investigator general issue, or a congressional reprimand, not a criminal investigation of the Fed chair. That escalation doesn't actually match the alleged offense. So we need to zoom out here. President Donald Trump has been publicly attacking Jerome Powell for over a year now. He's called him incompetent, he's threatened firing him, and he's demanded rate cuts. This is something the president does not have legal authority to do. Powell, on his part, has been very clear. He says no, and legally, he's correct to do so. Powell's turn as Fed chair ends in May, but his seat as Fed governor runs until 2028. So if the White House wants Powell fully removed, it can't just wait him out. It would need cause, and a criminal investigation does just that. Now here's the part that most people are missing. It isn't about Trump's ego, it's about time. The US is sitting on $38.5 trillion in debt, a debt to GDP above 100%, and roughly $9 trillion in debt that must be refinanced in 2026. At the same time, the average maturity of US debt is shortening, meaning more borrowing is happening in short-term treasury bills and not long-dated bonds. At the same time, the average maturity of US debt is shortening, meaning more borrowing is happening in short-term treasury bills and not long-dated bonds. That creates a problem. Short-term debt has to be rolled constantly. And if rates stay high, refinancing becomes exponentially more expensive. That's why the Trump administration doesn't want rate cuts eventually down the line. They want them now. The Federal Reserve has a dual mandate. They want price stability and maximum employment. The Federal Reserve does not have a mandate to make government debt cheaper, support financial deficits, or protect political timelines. Powell is debating like a traditional Fed chair. Powell waits for data, he watches inflation expectations, and he moves slowly. However, from a political perspective, that's unacceptable. But from a monetary credibility perspective, it's what's needed. This tension is intentional, and it's why the Fed was actually designed to be independent in the first place. So let's be precise here. The base case is that this investigation on Jerome Powell is a pressure tactic tied to rate policy and debt urgency. However, there are some alternative explanations in place. The DOJ could be acting fully independently here. Renovation cost optics could become potentially explosive, especially in a political sense. Another reason could be Trump is actually using the pressure for leverage, not full removal. But here, however, is why the base case dominates. The timing aligns with refinancing pressure. The penalty escalation is disproportionate. The target is actually the Fed chair, not the institution. The policy disagreement is explicit and public, and this is not subtle at all. There's also an important second layer. Lower rates usually risk higher inflation, but the administration appears to believe that it can suppress inflation via energy supply. Deregulation, increased domestic production, and aggressive foreign oil access. Exactly the reason why the US is taking over Venezuela and currently is in negotiations over Greenland. If energy prices stay low, inflation stays contained, in theory. However, flooding markets with supply while cutting rates introduces a new risk: deflation and capital flight. This is an extremely narrow path, and the Fed is not at all on board. This is why, in Trump's eyes, Jerome Powell is an obstacle. Now here's the part that should really concern you. The stock market has barely reacted. Stocks have shrugged. However, gold and silver are at all-time highs. Long-term bond dynamics are unstable. Liquidity expectations are driving complacency. This exact divergence tells us something will happen, and it's already priced into the market. The markets already assume that Jerome Powell will succumb to Donald Trump. The alternative explanation could be that independence no longer matters, especially when it comes to the Federal Reserve. If monetary policy becomes subordinated to fiscal needs, the dollar's credibility erodes, even if asset prices remain fully inflated. This is how confidence is lost in government without an actual crash occurring. It's through normalization, as it's occurring here. So right now, it's not about building renovations. It's not about a testimony. It's actually if Jerome Powell can still say no. We are dependent on whether the US can refinance trillions and trillions of dollars without breaking the trust that holds the entire system together. The important thing here is if Powell folds, this becomes precedent and normalization for future generations. If he doesn't, this situation will escalate. Either way, the fact that I'm even here talking about this means that the situation is escalating and that something fundamental is changing. Thanks for watching this video, and I'll see you in the next one.